Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, it's great to see you.
Good to see you too, Ivan. Thanks for having me on.
Yeah, it's an absolute pleasure. So, Mike, firms like Apple, Amazon, and Twitter, they're cutting their workforce. And now we just got news of Meta, they're cutting 11,000 jobs. Will these layoffs cause the Fed to change direction? What's your thoughts?
Eventually, not yet. That's the problem. The whole mantra for this year, beginning right about this time a year ago, is don't fight the Fed. And here we are towards the end of the year. Everything started to break down. And the mantra remains don't fight the Fed. We still have more Fed tightening in the system. We have the most central banks on the planet tightening. Despite the U.S. tilting towards recession, the world tilting towards recession. Key fact I like to point out is our Bloomberg economics team recession model from Anna Wong, my colleague, is at 100% for the U.S. next year, and the Fed's still tightening. This is a 1929 type scenario,
Wow.
and now we're seeing that towards the end of the year, people are just hitting their stops.
What are you looking for in order for silver and gold to break out? Is it the Fed pivot ultimately, or is it something
Yeah.
else?
Bottom line is typically the Fed pivot. Now, maybe finally gold hit this bottom around 1600. Silver's unfortunately going to trade more like copper, which might be bottoming. I don't think it is yet because China's still in a major economic contraction and maybe not show it yet, but it's still in decline. But the key thing is the Fed pivot. I mean, so let's look at the facts. The gold has made new highs this year in terms of the euro and the yen and most other currencies. And typically that's a sign to eventually do it in the dollar. So it's doing what it's supposed to as far as helping protect people from currency debasement. Now, the dollar's been absolutely strong on the back of this strong, this almost unprecedented Fed tightening in the face of economic weakness now. So that's the main sledgehammer for gold, but I think that sledgehammer is pounding out a foundation. I think by the time we speak, maybe this time next year, Ivan, the key enduring theme will be enduring deflation, recession, and gold should be one of the better performers as we pivot towards a weaker, towards Fed maybe easing. The fact is, in my lifetime and potentially in the future, but we'll probably never see the ease of easing we've seen from the past from the Fed, particularly in my
Right.
lifetime since being in the trading pits in the 80s where I started in business. I do believe what Norio Rubini says, the Fed's going to eventually wimp out. My interest rate colleague in Bloomberg Intelligence, Ira Jersey, point out he fully expects bond yields are peaking. Now, rates
Mhm.
are a different story, and he's been spot on this year. So I like to sometimes go to my colleagues. That's the key thing about in Bloomberg Intelligence. When we all kind of align, last year we didn't. I was the predominant bear out there.
Mhm.
And didn't get a lot right, but basically got the great reversion of 2022 right. And it's just kicking in. But gold should come out ahead. Silver eventually, all the precious metals eventually, but gold should be the number one as we head to this enduring deflationary recession, which is my base case.
Mhm. Now, with all the chaos going on in the market, where are you putting your money right now? Is it more gold, or where are you putting it?
So I can't give investment advice, but I
Yeah,
can.
of
My
course.
job is to say this is where markets are going. I fully expect in the next few years U.S. long bonds, gold, and eventually Bitcoin will be some of the best performers. Now, Bitcoin has broken down hard last week, as we're probably going to be hitting the tape on the weekend, and
Mhm.
that's a key risk-off indicator for everything. But it's becoming a digital version of gold. And the way I look at it is being bullish and involved and allocating to gold without some Bitcoin and some Ethereum in that space may be somewhat highly risky because Bitcoin is becoming the digital version and the world going digital, but it's just a nascent asset. But I do fully expect gold to, my base case in gold is it's going to eventually get above $2,000 an ounce when we least expect it in terms of the dollar, and then never look back. It's that kind of technical and fundamental setup. And right now it's that pain that you have to take in markets before the gain.
Mhm. So, Mike, we're seeing huge numbers get depleted from the LBMA and the COMEX. Do you believe that trend will continue as well?
Yeah, that I have found has not been a good leading indicator for prices in terms of there's so much shenanigans that go on in precious in all metals
Mhm.
inventories now. And one of the lessons I learned is I just haven't found a high R-squared correlation. And sometimes I find the exact opposite correlations when I watch copper and gold and things like this. So I don't find that as a good indicator. No, some of my colleagues do watch it. In terms of gold, I look at the macro. To me, that's the 10. Particularly in this year, everything else is a 5 or lower. And particularly when the Fed's pounding this hard, that's the predominant 10 on the planet for everything. So to me, that stuff is all kind of noise. In some of the other commodities, it makes a lot of sense to watch it. Things like stocks to use. I watch that very closely in crude oil and in the grains, but I have not found that as a good way for indicating prices in the metals, particularly gold and silver. And copper, but some of my other colleagues do. I'm looking at the macro. The way I see it is what's going to happen is the enduring trend of gold outperforming copper should resume, and that's kicking in. I mean, copper at the time we're speaking is down 16% on the year. Gold's down 6%. I think that's going to accelerate as we head towards this global economic recession. Just an FYI, my Bloomberg economics team, economics leader in China says we need another 25% correction in that property crisis. So when you see that, you don't want to be buying copper yet. Eventually, that's going to be the time and thing to do. But gold, to me, is the one to look as the shining star if we head towards this type of scenario, which I expect. Key question I like to ask, Ivan, is what stops this reversion process of the whole world tilting towards recession as if central banks are tightening, and then the pendulum swinging back towards enduring deflation, which was kind of the case before COVID, which I don't think it's changed. It just got spiked with massive money supply, and that money supply is being taken away now. And at some point, we'll have to start pushing on the pumps again a little bit as economies absolutely decline. So look at Europe. Almost a recession, clearly recession already. Our model for the U.S. 100%. In China, you see what's happening with the political situation there, pushing back towards the years of Mao. I see gold as potentially the shining asset. But then, what happens is silver outperforms, but only if it gets copper on its side.
Right. Now, let's move on to energy prices, Mike. Are we seeing a replay of 2008 with energy prices? You said, I know in a recent interview that at some point this year, there will be an energy collapse. Can you expand on that?
Yeah. Well, firstly, that's not profound to say that. I'm just one of the few who's been way too early, ahead of the game. And you used to have hair. And that's just part of my job. It's used to being too early, but what I see is the price of WTI right now around $86 a barrel is double the cost of production of the world's largest producer. That's the U.S. About $40 a barrel. 2014, which is when our data starts, it was the cost to produce one barrel was $70 a barrel, 70. It's that downward trajectory. And then it's also the key factor what's happening globally. Now, the demand destruction is just early days. Now, we're all seeing it, and I pointed out it's going to happen just at the beginning of the year. It always happens when you spike at this velocity, particularly when you're tightening rates and China's in decline and the dollar's strong. It's just always has happened. The question is, what's different this time is this narrative that people say they ignore the rules of Adam Smith and free markets in supply and demand elasticity. So I fully expect that to continue. The bottom line to remember in energy is what's been the most powerful pressure force for at least the last 10 years, certainly since the peak in 2008. I need to point that out. The high for crude oil was 2008. This year we got almost near there and we're going back down again. But the biggest pressure has been the trend in North America, U.S. and Canada, production exceeding consumption. Now that trend started almost 20 years ago. It's been enduring. It's had a little bit of a wobble with COVID, and it's going back to trend in my view. And that's both sides of that supply-demand equation. And a lot of that's because of rapidly advancing technology, which means digitalization, electrification, and decarbonization, which means demand for copper and aluminum in the big picture. But right now, I fully expect crude oil is going to head back towards 50. Been way too early. I've got a lot of people call me a complete idiot for that. Now, was that 130? I was looking like an idiot. Now it's below 90. I'm looking less like an idiot. But I'll end with this. Macro and micro, that's my macro view. Key thing to remember, stocks to use. You want to mention inventory. Stocks to use has bottomed in the U.S. is heading higher, which is typically marks a peak. Stocks to use on a global basis has bottomed and heading higher, typically marks a peak in prices. But the bottom line is recently had this big spike in energy prices 2 weeks ago because we're hitting the tape on Saturday. And that was coincident with a pretty sharp decline in open interest. That's an indication of short covering. That's a lesson I learned in the trading pitch in the 80s when you used to have to go get the sheets. It wasn't electronic back then. I just, but that's just one of those simple lessons you learn. That was short covering. So I see Brent has put a pretty good ceiling around $100 a barrel. I see WTI initially heading towards 75, which is unchanged on the year, and following copper, and which is down at the point we're speaking. It was down 20%, and I think it's going to end up maybe down 20%, maybe not this year, but it's you see everything's tilting. The key thing that you need for energy to rally now is you need that stock market to completely jump higher. And what I see is all correlations are going to one as stock market breaks down. You know what's been a key leading indicator for that, even?
What?
Bitcoin and cryptos. It's been one of the best lead indicators this year. It broke down hard last week, and it's just been a trigger, and everything's falling because people have their hands on these tight stops. The only asset class that's been up this year has been commodities. They're starting to give up the ghost, and if you're bullish, you're fighting the Fed.
Now, I know you were saying that eventually you said that oil will go to 50. Is that what you were saying?
WTI, I fully expect to go to around 50. That's been the enduring price, the most widely traded, almost the mean median, essentially the mean median mode since the breakdown in 2014 on the back of excessive supply of the U.S. and lack of demand. And the key thing, what happens, if that doesn't happen, it's different because we're heading towards a global recession. I pointed out the statistics for the U.S. I see what's happening in Europe and see what's happening in China. And that means WTI typically, and crude oil and energy typically gets cheap. That process helps reset. It helps reset that demand, bring back the demand and pressure supply. And it hasn't happened, and that's part of the reason the Fed's tightening harder. It's one of the biggest bait and switches I've ever seen in history. Now, we saw inflation numbers heading really high. We had the war, the big spike in energy, and then we saw the acceleration and tightening from the Federal Reserve. Now, if crude oil had broken down, they would not have tightened so much because that's a leading indicator of deflationary forces. It's starting to do that. So that, to me, is the key sore thumb at the moment. Commodities almost have to break down, or central banks will keep tightening until the whole global economy tilts downward. And I see right now we are in the midst of one of the greatest macroeconomic resets in our lifetimes, and it's early days.
Wow, that was incredible how you put it. Now, what happens if OPEC, they decide to just keep cutting production so they don't want oil prices to go down and just be a sore thumb in the Fed's, they just don't want to cut. What happens when they cut production, OPEC? What do you think happens?
Well, they are, and they have. And typically the biggest cuts in OPEC production in history have come with sharp declines in prices. 2008-9. And then the big one is 14, 15. And the way that's just the way it works, because they are not stupid. They're following markets. They see the things I'm saying. They see what Federal Reserve and central banks are doing. They see the global economic GDP forecast tilting downward. And there's no sign of a trough. It's just starting to head lower. All these, just the latest inflation data out of China, crude oil imports out of China. I mean, the data from China is just horrible. Yes, they're COVID lockups right now, but then we have the property crisis. As I think I might have mentioned, our economics team in Asia says there's another 25% to go in property crisis in Asia. This is not me. This is my group and team in Hong Kong. So OPEC is responding responsibly for a cartel whose job is to keep prices higher. But let's look at the significance of OPEC. 10, 15 years ago, they were almost 40% of global supply. Now they're trickling down to 30%. You see that trend?
Yeah, it's going
less
down.
and less significant. They made themselves redundant. They're becoming more redundant. 10 years ago, from now, when I hope I'm still alive, and I hope we're talking, they're not going to matter. And they're maybe 20 or 15% of global economic production. We are seeing the greatest shift in auto manufacturing ever towards EVs. 20% of auto sales in China last year from our Bloomberg New Energy Finance team was EVs. Yeah, and the key thing I like to point out is I remember I was head of commodities at S&P, and that was, 15 years ago or so, and the key mantra was, peak crude oil production. And guess what happened? Peak U.S. consumption. U.S. consumption of liquid fuels and crude oil has been declining essentially since 2005 with some bounces, and that's on a total consumption of barrels basis. That's not relative to GDP versus GDP. It's plunging. So the U.S. used to be the world's largest demand pull source of crude oil. Now we're a competitor to OPEC. We actually provide the most LNG on the planet with a little blip right now, produce the most, and if you include Canada, most liquid fuels with crude oil on the planet. That's just by adopting the technology. So to me, that's part of that downward trajectory. OPEC gets it. OPEC knows they're becoming redundant. If they're smart enough, they see the world 10 years from now. What happened this year is going to turn out to be one of the greatest shifts away from fossil fuels towards renewables ever. Because the key thing that happened before is it was not really economic.
Right.
We didn't have a major motivation. Now we got dicey sources of fossil fuel from Russia, supported by China. One of the biggest mistakes Mr. Z made in the history of China is cozying up to Putin before the invasion. And now everybody in the planet wants to not do business with China. And China is a major export economy. So what does that mean for the primary demand pull source of crude oil on the planet going lower? So I see a lot of hopium. China was importing around 11 million barrels a day. It's dropped down. It's heading lower, and everybody said it's going to go up. And I'm like, have you heard about Mr. Z's policies lately? He's going back to the days of Mao.
Wow. Well, Mike, we appreciate you so much for coming down to Wall Street Silver. The knowledge was incredible. So, and we hope to have you back on maybe in 2-3 months.
I'm looking forward to it, Ivan. I love that chair. You look like Captain Kirk on Star Trek.
Oh, thank you so much. And again,
Right.
Mike, we'll put all your social media down below for everyone who wants to follow. We'll see you soon.
Talk to you later.